Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Welcome to the Deep Dive. We're here to really cut through the noise and get you the essential customized knowledge you need fast. Today, we're taking that shortcut straight into the lower middle market, the LMM M&A landscape, specifically what happened in Q3 2025. We're using Axial's pipeline data to see where deal makers are, placing their bets.
And before we jump into the numbers, it's probably good to set the stage for you. Define the scope. When Axial talks LMM, and when we talk about it today, we mean businesses with a total enterprise value, TEV, somewhere between $2.5 million and $250 million.
Okay, so a pretty broad range, but definitely focused below the huge corporate deals.
Exactly. It's this really vast dynamic mix of small to mid-sized companies. And frankly, the activity here, it's often a pretty good leading indicator for the wider market's health.
Right. And to really get a handle on the supply versus demand dynamics here, we need to understand a key metric they use. Pursuit rate, we'll be mentioning it a lot. Yeah, it's crucial.
So what exactly is it measuring? It sounds important, but it really is. Think of it as the earliest signal of real buyer interest, way before you get to things like signed NDAs or LOIs.
Okay, so not the paperwork stage.
Not at all. It's more like seeing a deal teaser or a profile and actively saying, yes, this fits. I want to see the full deck. I intend to pursue this. It's that first positive nod.
Got it. So pre-diligence appetite, that initial spark of interest, gives you a good insight into buyer enthusiasm and maybe future momentum, right?
Yeah.
Before serious time or money is spent.
Precisely. It's a forward-looking indicator of where the energy is heading.
Okay, perfect. Knowing that, let's hit the supply side first, the deal volume. What was the big number for Q3 2025?
The headline number was massive. 3,320 deals came to market in the LMM.
3,320, wow. How does that stack up historically?
It's highly significant. It's actually the second highest quarterly total they've ever recorded on the platform.
Second highest ever. Okay, so the LMM is definitely buzzing. Sellers aren't holding back.
Not really, no. They're bringing companies to market at, like you said, a near record pace.
And if we look year over year, Q3 25 versus Q3 24.
The volume represents a pretty steady 7.93% increase. So yes, growth is definitely happening.
Okay, 7.93% is solid. But is it all smooth sailing? Does the report add any maybe caveats to that growth?
Yes, that's the important nuance. While nearly 8% is good, the report does note that the overall growth rate, it's actually moderated a bit compared to earlier in 2025.
Moderated, meaning slowing down slightly.
Yeah, kind of. It suggests sellers might be taking how did they put it, more measured and deliberate pace heading into Q4.
Interesting. So maybe the initial frenzy is cooling off a touch, people getting more strategic about timing or valuations.
That seems to be the implication. It's still growth, but maybe growth with a bit more caution baked in.
All right, let's drill down into where this supply growth is actually coming from, because it's not even across the board, right?
Not at all. 5 of the 7 big sectors saw volume go up, but one just completely blew the doors off.
Which one?
Healthcare. Absolutely dominated. It posted a, frankly, stunning increase of plus 27.3% year over year.
Wow, plus 27%. That's huge. What's driving that, do you think?
Well, it's likely a mix of things, right? You've got demographics, more tech being adopted in healthcare services, maybe some regulatory clarity settling in post-pandemic.
Yeah.
Sellers in healthcare are clearly finding a very, very receptive market right now.
Okay, so healthcare leads by a mile. Who's next in line for growth?
Business services came in pretty strong, too. That was up 13.07%. Solid growth there.
And then the others, like industrials, tech.
Yeah, those traditional, maybe more stable sectors, industrials, technology, food and hospitality, they showed more modest gains. Still positive, but hovering, between roughly 6% and 7.8%. Broad stability, but healthcare and business services were the real volume drivers.
Gotcha. But not everyone was up. Which sectors saw fewer deals come to market?
Right. 2 sectors actually saw small pullbacks in supply. Consumer goods dipped just slightly, minus 0.90%.
Okay, almost flat.
Yeah, and transportation was down a little more, minus 2.12%.
So what does that suggest for consumer and transportation? Seller hesitation.
Could be. Or just timing adjustments. Maybe concerns about supply chains lingering or, rising costs for labor and fuel impacting those sectors specifically.
Okay, so that paints a picture on the supply side. 3,320 deals, led by healthcare growth. Some moderation overall. But like we said, volume isn't the whole story.
Not even close. The real question is, where are buyers actually putting their energy? Where's that initial pursuit rate interest? This is the demand side, exactly. And comparing the deal volume rank where the supply is with the pursuit rate rank where the demand is, that comparison, that's where you really uncover the competitive heat map.
You see where things align, and maybe more importantly, where they don't align.
Precisely. The misalignments tell you where the competition is fiercest.
Okay, so let's start with the baseline. Is there a sector where supply and demand seem perfectly matched?
There is. Industrials. It ranked #1 in deal volume, the most businesses up for sale.
Okay, highest supply.
And it also ranked #1 in pursuit rate.
First in volume, first in pursuit. Okay, perfect alignment. What does that tell us?
It really speaks volumes, I think, about the consistency and perceived durability of LMM industrials. Buyers get the models, they trust the assets, they see it as, fundamental to the economy. It's kind of the bedrock where M&A just works predictably.
Steady as she goes for industrials.
Yeah.
But you said the real insight comes from the misalignment, where buyers are chasing maybe limited supply, the scarcity premium.
Right. And technology is the absolute poster child for this in Q3.
Okay, how so?
Well, tech ranked pretty low in deal volume, only 6th place. So relatively few businesses listed compared to industrials or food.
Right, not a ton of supply.
Its pursuit rate. It shot all the way up to 3rd place.
6th in supply, 3rd in demand.
Mm-hmm.
Wow, that's a big gap. What does that signal?
It signals intense competition. Buyers are fighting hard for a limited pool of what they see as, scalable, defensible tech platforms, quality over quantity.
So when a good LMM tech deal does hit the market,
it gets immediate attention. These platforms often have specialized IP, maybe higher margins, and critically, that recurring revenue model everyone loves.
Recurring revenue. Why is that feature so attractive, especially now in the LMM?
Well, in the LMM, predictability is gold. Defensible tech often has high switching costs for customers, which means more predictable cash flow. That helps cushion against economic bumps.
Right, less risky.
Exactly. Buyers seem to be prioritizing platforms that don't need constant, huge capital infusions, but offer clear ways to grow fast. Think specialized B2B software, maybe niche fintech, stuff that feels resilient against inflation and uncertainty.
Okay, so tech is hot despite low volume. What's the other high heat area?
Healthcare again. We already know the volume growth was huge. It ranked 4th in supply overall.
Right, lots of deals coming online.
But the demand side, the pursuit rate,
yeah,
incredible. It jumped to 2nd place overall, and that's a big leap from just last quarter when it was 5th.
4th in supply, 2nd in demand. Another strong signal.
It's a really unified signal from the market on healthcare. High volume shows, sellers are active. High pursuit shows, buyers are equally eager. And this lines up with other reports showing, pretty steady valuations in healthcare services and tech.
So what are buyers looking for within healthcare specifically?
Seems like a lot of interest in bolt-on acquisitions, things that offer, say, geographic expansion or more specialization. Think home health, specialized behavioral health areas with strong underlying trends.
Okay, so we have industrials as stable, tech and healthcare as these highly competitive, high-demand markets. Now, let's flip the script. The high-volume caution areas. Lots of supply, but buyers seem hesitant.
Yeah, this is where it gets really interesting and maybe a bit concerning for sellers in these spaces. Food and hospitality shows the most dramatic disconnect.
Dramatic?
It ranks 2nd in overall deal volume, 2nd only to industrials, loads of businesses for sale.
Okay, massive supply.
Yeah.
But the pursuit rate?
Dead last, 7th place.
2nd in volume, 7th in pursuit. Wow.
Okay.
That's quite the cold shoulder from buyers.
It's a remarkable finding. Really forces you to ask why the lack of enthusiasm when there's so much choice. And consumer goods showed a similar, though less extreme, pattern.
What were the numbers for consumer?
Let's see. 3rd in volume. So again, plenty of deals, but only 6th in pursuit rate. Still near the bottom.
Okay, so food and hospitality and consumer goods, lots of businesses listed. But buyers aren't really biting, at least not initially. Why? What's making buyers so cautious there?
I think the low pursuit rates there reflect some serious ongoing worries about cost structures and unpredictable consumer behavior.
Cost structures like labor and materials.
Exactly. Take food and hospitality. If you're a buyer looking at a restaurant group, how confident can you be about projecting margins? Labor costs are volatile. Commodity prices bounce around. Can they pass those costs on?
The pass-through problem. Especially tough in the LMM, maybe.
Very tough. These businesses often compete heavily on price. If your input costs spike because of inflation and you raise menu or shelf prices, you risk losing customers to bigger players who might have better hedging or scale. That erodes the business's defensibility.
So the risk feels higher right now.
It seems buyers perceive the underlying business model risk as elevated. They're holding back that initial pursuit signal until they see really strong evidence of, cost control or a unique, maybe recession-proof concept. The volume's high because owners are listing, but the initial interest is low because of that perceived risk. That makes sense.
Okay, before we wrap up with the big takeaways, let's quickly clarify one more term for you, the listener. Deal intent. We talk about pursuit rate being reactive. Deal intent is the proactive side. It's basically a structured project a buyer creates on the platform before a deal even lists. They lay out their specific criteria, industry, size, geography.
So it's the buyer saying, this is exactly what I'm hunting for. Precisely. It's the demand side setting their parameters, putting out their fishing net, so to speak. It just reinforces that sophisticated buyers, they know what they want.
Okay, great clarification. So bringing it all together for Q3, we had that really robust deal flow, 3,320 opportunities. But clearly, volume doesn't mean deals are easy to get done across the board.
No, the overarching insight here is that the LMM M&A market is operating in a highly selective mode right now. Buyer interest, measured by that crucial pursuit rate, is heavily skewed.
Skewed towards
Sectors that buyers see as offering resilience and scalability. Specifically, that's healthcare and technology, even though they weren't number 1 or 2 in sheer volume.
So the market's making sharp distinctions.
Very sharp distinctions between businesses that look vulnerable to short-term economic pressures, like maybe some in F&H or consumer, and those that seem capable of generating more durable, predictable cash flow. If you're selling a food and hospitality business right now, you need a really compelling story on margin protection to move the needle.
A clear picture of a discerning market. Well, that wraps up our deep dive into the Q3 2025 lower middle market M&A pipeline data from Axial. Thanks for taking the time to absorb this insight with us today, and maybe we can leave you with one final thought to chew on. Given that stark contrast, high volume but really rock-bottom pursuit rates, consumer goods, and food and hospitality, you have to ask.
Is this just short-term market anxiety, nerves about inflation, interest rates, or could this data be signaling something more fundamental? A longer-term shift in what buyers actually consider a defensible LMM business model?
Meaning, could this skepticism become permanent for some sectors?
Potentially. What if this lack of initial enthusiasm permanently resets the valuation floor for these high-volume, maybe lower-margin sectors? Definitely something to watch very closely as that critical Q4 data starts to roll in.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.